The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, it's a big day ahead for everybody, isn't it? A very warm welcome to Squawk Box Europe with Karen Cho and myself, Steve Sedgwick, and these are your headlines. Well, all eyes on Jackson Hole as the Fed Chair Jerome Powell prepares to deliver his pivotal keynote speech, with political pressure looming over the summit and policymakers split on the outlook. The Kansas City Fed President Jeffrey Schmid tells CNBC a rate cut is not certain.
I think we really have to have very definitive data to be moving that policy rate right now. But yeah, I think there's a lot to be said between now and September.
Another down day on Wall Street as the S&P 500 sees its longest daily losing streak since January. In a week that has seen fears over the outlook for AI hit the world's biggest technology names. Nvidia reportedly looks to halt production related to its China-focused H20 chip as regulators in the country raise security concerns and urge local tech firms to stop purchases.
Tech, bubble, AI, central bank, independence. You can almost kind of see the thought bubbles that everyone's thinking about at the moment, and they are the key issues. I know that you absolutely want to look at tariffs and Walmart later on as well, but I can't get away from tech and central banks.
The tug of war as to why the market is selling off this week, is it because expectations for a rate cut in September are dwindling, or is it because of an AI bubble? I mean, what's in the driver's seat here?
The market hasn't sold off this week. 7 out of 11 sectors have been in positive territory. The market looks like it's sold off because the biggest, the daddy, the mummy of sectors has sold off.
There's caution out there, though, in the growth areas of the market, and that is sometimes a credit, it's a borrowing story.
As central bankers from around the world gather in Wyoming for this year's Jackson Hole Symposium, the Fed continues to teeter on the tightrope of its double mandate. What's worrying the central bank most? Inflation or labour markets? Well, I'm going to add something else in there. Inflation or labour markets or its own independence. Cleveland Fed President Beth Hammack made her position clear, telling the Wall Street Journal that she sees an inflation picture that is too high and rising and moving in the wrong direction, whilst the labour market remains reasonably good. Meanwhile, her colleague from Boston, Susan Collins, took a different line on labour markets, telling the paper that if data before the Fed's next meeting in September indicates a risk of worsening labour market conditions compared to the inflation picture, it may be appropriate soon to begin dialing back. And again, the market thinks it's going to happen, don't they? Traders seem to be putting more stock on Collins' position, eyeing a September rate cut after the Bureau of Labour Statistics revised its June non-farm payrolls figure lower by more than 130,000, and May's to the tune of 125,000. Outside of the pandemic, that's the biggest reductions in payroll gains figure in a second revision in more than 40 years. But uncertainty remains. Markets are pricing in a 75% chance of hang on a second. Yeah, that's down more than 15 percentage points in the week. In fact, it's down from the 100% they were pretty much at before, according to the CME's Fed Watch tool. Well, if only we could go back in time. Well, we're going to do that for you in Squawk Box because we're going to go to Los Angeles, where it is today. Not tomorrow yet for LA, if you see what I mean. Naomi Prinz is the founder of Prinsight Global. Love chatting to you, Naomi. We've got so many things to ask you. Okay, let me just ask you the question I was asking in my read at the top. Is the biggest thing on the mind of the central bank and the governor today, or the chair today, is it A, inflation, B, the labour market, or C, the independence of the Federal Reserve? Good morning or good evening to you.
Good morning to you. It is a big day starting over there, almost ending here. But yes, going into the big Jackson Hole speech. I'm going to throw out D, which is I think he's concerned about his own exit. In other words, when he does exit in May 2026, and how he basically shapes what the Fed has done underneath his watch, and it's been in a lot of places. But last year at Jackson Hole, the core CPI or inflation was the same as it is now. The labor market was pretty much the same as it is now, which is the same unemployment rate, a bit better in terms of continued claims or long-term claims for unemployment than it is now, but pretty much the same. And he used that podium to accentuate the dual mandate, inflation versus the labor markets. And then the Fed went on to cut rates by 100 basis points from September through the end of the year. And the market was equally jitterish. I think the percentage probability on the CME Market Watch tool was pretty much similar to where it is now. So everything is lining up the same. In terms of Fed independence, though, because you asked, that's interesting because the big difference is that 3 of the Federal Reserve governors on the FOMC board are effectively going to vote for cutting rates. 3 probably won't. And now the light really does shine on Powell as to where he goes and how he uses this speech coming up at Jackson Hole to position himself to exit strong.
That is fascinating, and I love your D, and that's why we adore having you on the show as well. But in the meantime, and you talked about the May exit as well, the pressure is only going to be turned up by the president, by the administration, by the people who believe that the president is right, and he may well prove to be right, and actually interest rates need to be dramatically lower as well. Very interesting question, actually raised by Juliana Tattlebaum more on the show than anyone else, in fact. And that is, actually, do you think he could become more intransigent to rate cuts because of the pressure being put on him, rather than looking at this with a clear eye?
I think he could. And I think that's where the market has gone from a 98% probability of a rate cut in September to a 75%, which is still very high. And again, about where it was last year at this time. And that's because he can be. He knows he can't be removed. But again, that lights on him to be that deciding vote. And I don't think he wants to make a mistake. I don't think that intransience is going to have him not decide on a rate cut, but it might make him look at the data that comes out in the next payroll number, which is going to come out before the FOMC meeting, a little bit more closely. I think he's kind of hoping that the labor market is going to stay pretty much as weak as it looks right now, which is, again, about the same as it looked last year when they cut rates by 100 basis points throughout the rest of the year. And that will give him runway to effectively use the labor markets, because, again, that is the theme of this Jackson Hole meet this time, and it will allow him to side on cutting rates. That's what I think he wants. I think if the number isn't there, he's going to also be happy to try and wait, but he's very uncomfortable right now.
Nomi, getting into the weeds on the data, it feels on one side we've got this very weak labour market that is materialising what the average, 3-month average of job gains going from 150k to 35k. So that is a huge change. But on the other side, the reason why you're not seeing the vote come through aggressively for a reduction in interest rates, because the CPI number is not back on target. And if you look at the services component still, that is 3.6% in June. Plus, we've got the tariff impact on the goods inflation also expected to hit at some stage. How do we think about those inflationary elements undermining the case around that weakness we're seeing in the labour market?
Well, again, that come out as different data, but we're still at a 3.1% core. And this is with all of the expectation that was attached to tariffs coming in. This is with kind of a preemptive strike in terms of buying goods and raising prices on commodities and on supply chains in advance of tariffs being pinned down. And now we have a bit more clarity on that. Of course, there's going to be a lot of deals back and forth between nations, even though we're officially in a sedimented tariff zone. But there hasn't been as high an increase in the overall core CPI rate as Powell kind of thought there might be. And this is very similar actually to 2019 when the original Trump 1.0 tariffs came in. It was a sort of similar situation, except rates were quite a bit lower. And Powell had also at that time said, he was concerned about inflation going too high because of those tariffs. And what wound up happening actually between September and the end of the year as well in 2019 with those tariffs of 2018 taking effect was that the banks started getting very concerned about liquidity. So I just want to point out that the banks right now are very much in the camp of rate easing and potential QEing, because they have actually purchased more treasuries in this current quarter that just ended than they have ever in one bout of treasury purchasing. And this is when treasuries are at all-time highs in terms of our $37 trillion of debt. And they are buying. Goldman Sachs and JP Morgan's reports just showed a 20% increase quarter on quarter of buying treasury bonds into this season, into Jackson Hole through the end of the year, into what the Fed looks like right now. And that's kind of a bet that says no matter what happens with inflation, there's going to be activity from an easing perspective, and we are positioning big in front of that activity.
That's incredible, isn't it, Naomi, around the short end of the curve. There have been further issues, though, around the long end of the curve as we talk about central bank independence and what sort of premium investors will demand to hold treasuries down the track if we continue to see these attacks on the independence of the Fed. And Lisa Cook was the headline story this week around allegations of mortgage fraud, effectively another Biden appointee who would be there long beyond Trump's term in office. So a fairly central position for Trump to try and target if he does want to have dominance, heavy say in terms of the board over the Fed. How are you thinking about the developments this week and the sort of pushback we could get from even other voices at Jackson Hole today?
You know, it's very interesting. I mean, the administration has effectively been going after whatever is loosely available, and at the moment that's kind of on deck. And if you do get a 4-3 situation in terms of the governors by anyway, then of course we're going into rate cuts and we're going into potential QE and we're going into that 20% increase in treasuries that the banks seem to think might happen on the long end of the curve and so forth, and that could then take us into May 2026. Although that seems to have abated, it was definitely being brought up. It was kind of like a targeted, I don't know, sort of mini coup on the FOMC board in advance, but that not having happened, we do go back to Powell, and we do go back to seeing if the data is such that he can, from a standpoint of his own credibility, ignore a bad print on payroll if we get that in the beginning of September or not. And I think, again, he's going to want to see a lower print in order to reduce rates, but also the labor market is quite soft. And I think we're going to hear that in his speech. He will have to admit that it is actually softening. Inflation has not gone as high as they would have expected it might go because of the tariffs. It's still higher than this 2% level, but it was last year also, and it hasn't really ratcheted up much this year at all.
So, Naomi, let's go for a scenario. I want to know what could go wrong, and I think our viewers would like to know what could go wrong with the present scenario that actually ignore the inflation print. It's under control. We should have dramatically lower interest rates and a dramatically lower cost of money for everyone, of course, including the government, which would save billions of dollars of interest. What could go wrong? Okay, so let me just say, so inflation remains robust, interest rates go down aggressively as well. How bad could it get if this is wrong?
Well, if this is wrong, we have more of a speculative bubble and more leverage going into the market, and that's where Wall Street wants to be and where it's positioning themselves. If we get the rate cuts, if we get any form of QE, and additional pressure from Wall Street saying, like, look, we have had rates too high for too long. We are seeing delinquencies. We are seeing defaults. We are seeing corporate loans not pay. We are extending and pretending as much as we possibly can, and there's a lot of loans that are going to come due in the next year or two, and we are scared. Then that's going to position us into the same type of effectively backstopping debt, backstopping Wall Street that's gotten us into issues like the financial crisis, not for the same reasons and not by the same magnitude. But it does create a situation where if you over reduce rates and if you start really going into QE to help some of that liquidity or some potential loan problems that are coming into bank balance sheets, then you do have that potential setup for some form of just additional speculation leverage in the market, and that never really works out well at some point. But I don't think that the Fed, this Fed, or even the new Fed under non-Powell in May 2026 is going to be as aggressive as the market might hope it will be. I think it will be obviously more aggressive than what we have seen so far under Powell, but I don't think it's going to really, we're not going to see a 1%, 2% interest rate environment or anything like that in the ending 2 years of the Trump administration.
Nomi, the reality around tariffs is that we're waiting for the impact. We've had so many conversations about front loading, what the margins are doing, where the merchandise companies are trying to just wear it, take it on the chin for now, but eventually the consumer is going to end up paying for the higher costs that have been coming through. If the interest rate cuts coincide with that, it provides some cover for households, more in their wallet to cover the higher costs. But does that entrench inflation down the track if there's no pushback and the merchandisers, the wholesalers can simply just pass on the increases?
Yes, it will increase prices. That will increase inflation. And this 3% number that we're seeing and that we saw again last year is still not low inflation. It does still mean that prices are going up. They're just going up at that percentage level. They're not going down. They're not staying even. And that has an accretive value to it. And also, though, if rates come down, what tends to happen is consumers will go back and tap credit. And right now, we already have record high household debt. We have record high credit card debt at a higher interest rate over the last few years because rates have gotten into this 4.5%, 5% level, and that has taken credit card rates up to 25 to 29%. There's a lot of debt that consumers are holding. And so one of the things that happens, and one of the reasons perhaps we haven't seen as much inflation, even with these tariffs coming in and even with companies raising prices on their products and on the supply chain, is because consumers are sort of tapped out on the cost of debt and the amount of debt that they have taken. Now, if rates come down dramatically or continue to come down dramatically over the next 2 years, or from May onward, or even from this quarter onward, then we might see more tapping into credit. And what that just creates is pushing forward the problem. We will have more treasury debt, we'll have more consumer debt, we'll have more credit card debt, and that creates this economy again that's sort of built on that, and that allows prices to increase because which causes inflation because there's money coming in on the back of new credit. So these are problems in general for the economy.
Yeah, just to add to the mix. Nomi, lovely to see you. We'll love to see you again in London soon. I know you'll be over at some stage. Nomi Prinz, who's the founder. Fantastic. Well, make sure you come and see us. That'd be perfect. Nomi Prinz, founder of Prinsight Global as well, joining us. It's still Thursday in LA, of course. I've seen the future, though. It's great. It's called Friday. Don't miss our continued coverage from Jackson Hole throughout the day on CNBC. We'll bring you Chair Jerome Powell's keynote speech at 3 p.m. London time. And we're going to hear from the Cleveland Fed President Beth Hammack at 4:30 London time. All right, coming up on the show, the US and EU release more details on their trade deal. We're going to dive into the sectors that avoided the crosshairs. Plus, are tax and pension reforms prompting an exodus of the mega rich from the UK? Well, we'll have a look at that. And Nvidia looks to halt H20 chip production after China cracks down on purchases. Wedbush's global head of tech research, Dan Ives, joins us to talk all things tech and AI. That interview, 9:30 London time.
Let's take a look at what we're seeing on the US market action. Just looking again at the numbers, fascinating that we keep talking about a tech sell-off, but in session yesterday, it was Goldman Sachs that was the worst performer for the Dow, and it was a bunch of retail stocks that were the worst performers for the S&P and for the NASDAQ. So for instance, for the S&P, it was Walmart that was the underperformer. Oh, don't forget, of course, we had numbers from the big box retailer, but for the NASDAQ itself, it was Costco that was the underperformer. So none of these are AI names, but there's no doubt there have been questions lurking about the amount of capex on AI, given an MIT report about the sort of returns based on the huge investment that is happening right now. But a lot of moving pieces in private and public markets around this AI build-out. A look at US tech for the trading week as we look at that modest pullback on session yesterday. This is the extent of it. Nvidia down 3%. But again, the March higher in recent weeks in the lead up to earnings has been much stronger than this. Microsoft giving back similar territory. Meta, and don't forget the this is one digging deepest into its pockets. And even with the deal with Cloud and Google overnight, it was down 6%, 2 to 1% off Apple and Alphabet, and Amazon down heavily. And don't forget, this was the stock that underperformed during earnings season based on its capex and its AI story at this stage. So it was disappointing already in recent weeks. European futures, as we get going this morning, we've had a little bit of churn here too, some rotation around the defense names, sold off early in the week, bought back yesterday. As we gear up for the trading session today, we're looking at, again, a modest state of affairs. It's Jackson Hole day today. So from the US to Asia to the European markets this morning, we're setting the tone for caution as we wait for what Jay Powell will say and whether he's seen as more dovish, hawkish, data dependent. Any clues we get from here that is going to have a big effect on markets, Steve.
Yeah, absolutely. OK, let's take a look at the European Union and US and their talks, because they have formalised their trade truce. Well, that's good to know. Putting words to last month's handshake agreement between Donald Trump and the Commission President Ursula von der Leyen. The deal will see US tariffs cut on several key European goods down to 15%, including pharmaceuticals. But hang on, I thought on pharmaceuticals and semiconductors, haven't they got separate investigations going on at the moment? Oh, I'll come to that in a few moments' time because I've got someone who knows better than I do. Tariffs on autos and auto parts will also come down to 15%, but only once the EU has lifted all tariffs on US industrial goods. Also in the deal, a most favoured nation rate for certain European natural resources, aircraft and generic drugs, effectively lifting tariffs altogether on those items. Now, the person who was champing at the bit was the illustrious and award-winning anchor of Europe Early Edition. It's all true. It's all true. You were jumping together. I thought that that pharmaceuticals had separate investigations going in, Section 232.
But they're not going to apply to European companies. That's ultimately the deal here. Ultimately, whatever the announcement stateside is on the 232 investigation, the tariff on European semiconductors or pharma is not going to be above 15%. That's what the Europeans managed to negotiate here. So hang
on a second then.
Even though they're not concluded yet.
That's phenomenal news for the pharma sector, because but basically then what about if the 232 investigation does find that actually pharmaceutical pricing needs to be capped? Does that only then affect other players apart from the Europeans?
That's the information that we have at this stage. Which of course would be a huge relief for European pharma companies. And here though, let's also see how things will unfold, because the key question mark that I have at this stage is around the implementation. Okay, so now we have gotten these details. We have the joint statement outlining pretty much what we already knew going into this publication. But ultimately, how is this going to be applied? Let's not forget that the European Union works in several forms. So this needs to be approved by the member states, by the European Parliament. The European Commission has said yesterday that this approval is going to be done as quickly as possible to make sure that this relief and this certainty ultimately will be provided to European companies as soon as possible. But without that, none of these tariffs are actually implemented as of yet. Now, another sector that is important to monitor here, of course, is what is happening when it comes to car makers. Here's what Maros Shevkovich had to say yesterday at a press conference.
The 15% cap does not come on top of existing most favored nation tariffs. Instead, it includes them. Where existing tariffs are already 15% or higher, no additional tariff will apply.
Another important clarification there for Maros Shevkovich when it comes to tariffs on cars. But ultimately, when I was reading this joint statement, the only really new detail that I came across was what the European Commission was saying in terms of regulation. So we knew that the Americans had raised a lot of concerns about the Digital Services Act and the other regulations that the EU has. The confirmation in the joint statement says that when it comes to the Digital Services Act or any sort of digital regulation, there are no changes. There has been no discussion with the United States in terms of putting any sort of different legislative work here. On top of that, the one I noticed there's been a bit of a change from the European Union perspective is on CBAM. This is a green-related tax policy that the EU has. The EU has said that it will introduce flexibilities for American companies. Now, the Europeans have been clear, we are not changing our regulations, we're still going to apply our rules, but they will make it more accessible for US companies to comply with, perhaps by giving them a different timeline, who knows. But it was on the regulation side that I noticed a little bit more certainty and a little bit more detail that we didn't have before ultimately.
Can I bring up the poor beleaguered steel industry still facing massive tariffs, effectively 50% on any product that is produced in the EU. There's also some separate deal, some separate conversation that, look, there could be a future tariff rate quota for the EU, and the view is here that there could be some sort of ring fencing of domestic markets if overcapacity is an issue from China. So maybe some hope dangling there for steel?
Maybe, yes. But ultimately, this is also another area where this deal didn't cover, and we don't have, therefore, detail in terms of what tariffs will be applied, if they will manage to actually reduce them. But indeed, you are correct in saying that the Europeans did say, and they did confirm, that they agreed with the United States to cooperate on ring fencing. And of course, that rings bells in terms of, trying to protect what's going on here from a Chinese perspective. But ultimately, that is it. That is the only thing that the European Union managed to negotiate when it came to steel and aluminium tariffs, for now, of course.
It feels as though the Europeans have to see a whole heap of Chinese dumping of steel here and have to moan about it before there's any movement to ring fence this with help from the Americans.
And other products, too.
Yeah.